Hilton brings you new ways to stay. With experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Hello, everyone. Welcome to the Talking Real Money podcast with me, Don McDonald, and that other guy who just keeps hanging around named Tom Cock.
Hello.
There in the aircraft hangar. Look,
Yeah, okay.
He's so happy now. He's so happy because he's back on the podcast and he's not dealing with other business garbage.
Let's just not.
This is like a vacation from real life.
Yeah. For
It's
about
really
10
not,
minutes,
though,
sure. Yeah.
Because real life has kind of been nasty recently when it comes to money. And that's what this show's about. It's about money. Yeah. And the money stuff is just enough to drive you up the bloody wall. I literally have not looked at my portfolio now in 2 weeks, and I don't want to. I'm scared.
I think that's good advice. You know, I find it fascinating in today's Wall Street Journal that they talk about how pensions and others are really suffering after a very difficult first quarter, and now this difficulty's continued into the spring. And I'm thinking, wait a minute. You manage trillions of dollars, a fluctuation of a quarter. Is that really a big deal? Shouldn't be.
Yeah, at least it ain't Bitcoin.
Which is down 50% from its high.
54%.
They didn't have it all in Kathy Wood, the Ark.
The Ark of
sinking.
the Covenant.
Yeah. Down.
Yeah. All right. So today, though, we want to talk about versatility. Okay, that too.
We want to talk about versatility, too.
All the time. We want to talk about diversification. See, I combine diversification in my head and volatility.
Oh, okay.
All right, so it's diversitility. We're going to talk about diversitility.
Very important word in this business, as you know.
How versatile is your portfolio?
How fertile is your portfolio? Come on. I don't know.
Not too long ago, Mark Hulbert, a dear friend of the program, we love Mark.
We should do an interview with Mark one of these days, too.
We did. Didn't we do one with him at AARP?
That was like 5 years ago, dude.
Yeah,
that's a long time ago.
But I don't know. But Mark does these great factual number kind of pieces for the Wall Street Journal. And he recently talked about how much volatility, and how to get the kind of volatility you need in your portfolio, how many stocks it takes to get there. And right now, according to a recent study, the number is at least 50 stocks. You need to have at least 50 stocks. What?
To what?
To have
you said to
volatility. To diversify.
Nobody wants volatility. I want
reduce volatility.
Okay, because you made it sound like
diversitility.
Diversitility. I talk about having a bad day.
It's mainly your fault. You started my day off badly.
What? Me? Come on. I tried to call you. You don't answer.
Thing.
All right. Yeah. That's a whole other story.
Because everything all my technology is not working right now. I am so technology frustrated. And then I got to get on a plane today. So I can't fix stuff. Oh, yeah. Anyway,
and
50
I got
stocks.
a pile behind
50
you. You better know. Yeah. Which is a ridiculous number, by the way, to try to hold as an individual anyway. That's a crazy number.
Think about it. To hold a round lot of 50 stocks. No. We're looking at well over $1 million, and then you got to manage those 50 stocks to rebalance them, move them around, do all the things that need to be done. And the reality is, we think you need a much bigger number than that, Tom. A much bigger number.
And to give credit to my son, who recently got his MBA, we were sitting in a meeting once with somebody who had 211 stocks, and he said, "What about like a mutual fund?" Crazy.
That owns hundreds of stocks, or maybe thousands?
That owns a lot. The point of the study was to sort of say, how many stocks you need to own to reduce volatility, versatility.
Mm-hmm.
And 50. I think 50. I think Jim Cramer tells people to own like 20. Mm-hmm. It's a ridiculous. It's a ridiculous number. Just think that one 1/20th of your portfolio is relying on a single company. I think that's outrageous because things go wrong. And you can see it this year, right, with Netflix et al. So anyway, here's my couple points from this whole thing I think is worth considering. Number one, they always avoid the other part of the conversation. You should be diversified into not just a wide variety of stocks. Don and I have been telling you for years, to own thousands of stocks, but bonds as well, because bonds, although this year has been a little weird with interest rates going up, owning those are two completely different types of securities. So you should definitely own those. In addition, when it comes to stocks, I personally think, and we've said this, we manage money this way, you should be invested globally because not all economies are the same thing. The U.S. economy could be greatly different than what's going on in other parts of the world. That has been true. There's been decades where the U.S. stock markets have not done well and others have. So stocks and bonds. Number two, here's one thing I tell people all the time when they get very upset about what's happened recently, which frankly, by the way, I was just looking at the numbers. The S&P 500 year to date through, the 10th of May is down 15.7%, which really feels ugly, but it's not that bad. The global portfolio, 100% global portfolio is down 12.5%. So being globally diversified has meant less of a reduction. And I think I tell people this all the time, Don, when you feel exuberant about how much money in your account, I think you mentioned once when we were at the record highs, that people should realize that it won't always be that high because things go up and things go down. It's going to go down for a time. I think you should write down how you feel and put it away, either bad or good, so that you can go back and look and say, remember, I was like depressed. I had to do something. And no, I don't have to. And that brings me to number three. Be honest with yourself. If you look at stock markets, they go up, and bond markets, they go up and they go down. Volatility is part of investing. Get over it. It's going to happen. Or you can now put it in a high yield savings account. Don found one last week and it's paying 1%. There's your 1%. Go ahead. And by the way, just to point out, inflation as of today is still running at over 8%. So you can get your one while the price of gas and food and airplane tickets and all those things go up. So, I think this is overdone, the whole volatility thing. And I never tell anybody how to feel because my mom told me a long time ago, don't do that. But I will say that all of this is simply part of being an investor. Get over it or don't be one. It's kind of that harsh.
And guarantee yourself a loss.
Yeah.
And it really is, though. It's not about telling people how to feel, but it's about working within someone's emotional capacity. And that's why we say the portfolio, there isn't one right portfolio. It's the right portfolio for your capacity to emotionally handle the inevitable volatility that goes with stocks, absolutely, and with bonds to a certain extent, and with crypto all the bloody time. So you just have to be able to handle it.
Yeah, and to finish that point, I mean, you again, going back on your career in 2001, when you for years you'd been telling people, look, you can go do this on your own with a few index funds. And what you found was, in a time of profound emotional difficulty, when they actually closed, people forgot they closed the stock markets for a few days after the 9/11 attacks. And the markets went catered, and you found out that sometimes most people need help to keep us on the straight and narrow.
It was probably the busiest phone lines I ever had, particularly considering it was a tiny little radio network I was on.
Yeah, I was
swamped with calls. People going, "I can't. I'm getting out. I'm getting out, Don. I can't do it. I can't do it."
And this is another part of the reason that many of us, even our friend Paul Merriman, many of us have an advisor. Because
Paul's very emotional.
Yeah, not only do they build the right portfolio, not only do they do the planning, not only rebalancing, tax loss harvesting, all those mechanical things, the behavioral part, they can be really good at sort of keeping you in the plan, keeping you from doing something bad to your money. You were the one who made that point 20 years ago, and I think it's still very, very spot on. Really is.
Yeah. So build the right portfolio for your emotional situation, your emotional capacity, and diversify like crazy. So you never, ever, ever. The other thing about diversification that people forget, is that if you massively diversify, if one of your companies, bear in mind, you don't just own stocks, you own companies. If one of your companies goes out of business, goes completely bankrupt, goes to zero value, in a portfolio of 13,000 stocks, you're not even going to notice.
No.
But in a portfolio of 20 or even 50, well, now we're talking real money.
Yeah. Thank you.
Real money.
Well done, sir. Well done.
Thank you so much. And a lot of folks want to talk real money with us, and many of them call our phone number, which is 855-935-TALK. Others go to talkingrealmoney.com on the contact form, and you can record a question or you can type it in. Now, if you type it in, bear in mind, the answers are going to come in a little more, are going to come to the podcast a little more slowly. So you need to be more patient, you typists. Because I take them as they come in.
Is that a career anymore? Can you be a typist? I'm going to be a typist 3. I don't know.
I don't think so.
Stenographer 4.
Are you kidding? When I can tell my computer what to type and it just types it?
I'm just saying.
Oh,
typist.
Man.
It's a funny word.
I love that kind of technology. All right. I have an interesting question, though, that came in from Talking Real Money.
Okay.
All right.
Yeah.
I was going to do it in a bad Eastern European accent, but
all
I decided
go ahead.
against it.
Okay,
I'll do a little bit of Eastern Europe. Bad. Okay. Hello, cheesecake and CEO slapping lovers. It's your one and only fan from Poland.
Oh.
Thank you for your work and crappy sense of humor. I love it.
Well, there's our one and only honest fan from Poland. I like
Poland,
that.
Yeah. Crappy sense of humor. I love it. I got question. And he types it that way. That's why I want to read it European.
Okay. Was he calling me beefcake or you beefcake? I was trying to remember which one.
Cheesecake.
Oh, cheesecake.
You remember cheesecake?
I was hoping for beefcake.
Porn, cheesecake, and CEO slapping. Yeah. We had the CEO slapping episode.
I know. I was hoping to be called beefcake, but okay. Yeah.
I got question about small cap value ETFs available for Europeans. We got 2 of them. One for Europe, one for USA. The Spider MSCI USA Small Cap Value Weighted ETF, and the Spider MSCI Europe Small Cap Value Weighted ETF. Could you please take a look and tell me, do you think it's worth it? We have practically no choice if we want to invest in small cap value. P.S. Oh, he's going to enlighten us about Ukraine. You ready? Because we talked. Remember we talked about Ukraine.
Yeah.
P.S. Ukraine does not have its stock exchange. They are using our Warsaw Stock Exchange, even now when orcs attack their country. Orcs.
Excuse me?
Even now when orcs attack their country. Lord of the Rings. The orcs.
I get the reference, but that's wow.
Best regards, David.
Okay. That's pretty good.
Okay.
That's pretty good.
Thank you.
I don't think, by the way, I don't believe that we invest in Poland. I'd have to look it up, but I don't think we're.
I'm sure there's something.
It's a pretty small market. I doubt we are. But at any rate, so sorry about that.
Would you like to know more about them?
You know what they are. I'm curious. I already know what I'm going to say, but they are index funds. When you say weighted, though, does that mean cap weighted? That's
small cap value weighted. Yes, so they are overweighted to small cap and value.
Okay. So this is truly a tilt, if you will.
Yep, these are.
In other words, it's
funds.
Not just owning what market capitalization is. Okay, yeah, go ahead.
They're lovely funds. They're really terrific ETFs. Expense ratio for Europe is extraordinary because European, British, Canadian even expense ratios, Australian, are really high. The expense ratio on both of these funds is 30 basis points.
Wow, that's and for small value, pretty good.
Yeah, I think that's really good. It's totally shocking, and wow, good for you to have those available to you, and good for you for getting into them, and good for you for writing a very funny note. Thank you.
And by the way, but you didn't finish the question. So,
is there more?
No, I mean, so should he own both of these?
Yeah.
Okay, I was just waiting for you to say yes or no.
Oh my gosh, yes.
Okay.
U.S. and Europe. It's the only two he says he can get. He can't get the rest of the planet. But, when you have the U.S. and Europe, you have, Wow. What do you have, like 80+% of the global economy?
You have a lot of question.
Yeah.
So I'm just looking up my favorite, AVUV, which has an expense ratio of 25 basis points. So those two are pretty good price.
Right. I
Yeah.
mean, those are really, really good.
Mhm. Yeah.
Did you look up AVUV? No, not AVU. AVUV's that.
That's the
Let's look up
Avantis U.S. small value.
Yeah, it's U.S. I was looking for an international small value to see if they had
By the way,
Poland,
can
but
I make an aside
what?
about the Avantis small value?
You always do.
I know. Well, here's the thing I find fascinating. The number of people that have reached out to me and said, hey, I got to own that. I hear you talk about it on the podcast. I want to be careful here. That you should own that as part of a portfolio. That's not just one thing to own. You got to own U.S. large. You got to own all these other asset classes. This would be part of a portfolio. That's, what I'm trying to say. Not just, I'm going to sell this and buy AVUV because it's had a great run.
You make a terrific point because when we mention things, investments of any kind, we are talking about them in a much broader capacity. We don't believe in going out and picking A, B, C, D, E, F, G. We believe in having all of them, not picking one of them, but having all of them. Anything we mention here is not saying this is hot, buy this. No, we don't do that. That's not the kind of show we do. This is not Jim Cramer screaming, buy this, buy that. We're saying, buy them all.
Yeah.
Own a diverse portfolio.
Because that one seems to have caught a lot of interest. The other one, you won't be surprised to hear, I-bonds. Basically, every person I talk to, hey, you guys are always talking about I-bonds. I got to own some of those. Well, yeah, okay.
Yeah, and let me give you the caveat on I-bonds. Okay, let's say, possibly, over the course of the next year, the Federal Reserve's actions and the economic activity in the country, everything levels out and inflation drops back down to, let's say it goes to zero again. Could happen. It's happened. Now your return after 6 months, if it happens 6 months later, 6 months from now, your return goes to zero. So now you've got to hold those bonds. You've got to hold them for at least a year and probably 5, although if you're at zero and you lose 3 months interest, you're not going to care. But you're going to have a lower overall rate. Remember, that rate is only for the current 6-month period.
Yeah.
And then it adjusts.
All they see is what? 9%. Sign up for that.
That's 9% for 6 months, which means if there was a zero rate for the next 6 months,
guess what?
You're getting 4.5 for 4.6.
And then if there's 1% for the year after that, I mean, it's
right.
Okay. I don't want to use the word gimmick because you got mad at me for calling it that.
I don't think it's a gimmick. I do think it's kind of a hedge. If we have inflation, you got a little bit of those. You get a little kicker. It's not much, but it's a little. Every little bit helps. We say that over and over again. Well, remember, the easy way to get in touch with us is to either call us and leave your question or go to talkingrealmoney.com where we will try and answer all of your questions. 855-935-TALK is our phone number, talkingrealmoney.com. Tell your friends, share the podcast on social media, and, rate it on Spotify, review it on Apple Podcasts. Go watch our YouTube things. And please keep listening. And, join us. If you're listening to this on, the 11th, 12th, 13th of May, Retire Meet's on the 14th. You can still sign up for the virtual event or the live event if you're listening in the Puget Sound area at retiremeet.com.
Holding your vegetable sandwich for you right now.
Really, those veggie sandwiches were not popular.
They're horrible, but we always get like 50 of them, and then I end up eating 20 of them.
I think the people who ordered them went, I was
the
trying
roast
to be
beef
good,
looks
but
really good.
Boy, that roast beef looks good.
Yeah, exactly. Yeah. Like when you go to the ice cream place with your grandkids, you go, I'm not going to, well, no, that chocolate looks pretty good. I'll have this.
Yeah, I'm not going to have any ice cream because I'm too fat. I am.
A little bit's not going to kill me. Yeah.
All right, thanks for being a part of our little get-together called a podcast. I'm Don, that's Tom. We hang out talking real money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.